You're watching the January episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. Want to give you a warm welcome to 2025. This is our first episode of a brand new season, season 5 of First Look ETF. And as always, it is great to have you with us. Coming up on today's show, we'll examine a pair of recently launched equity ETFs with a value investing approach. And we'll tell you about an innovative private credit ETF with a unique income strategy. But first, to kick things off, we have Maital Legum with the New York Stock Exchange. Maital, Happy New Year. It is great to see you again.
Great to see you as well, Stephanie. I'm excited to kick off 2025.
Absolutely. So let's kick off the year with the latest update on the ETF launch activity. How are we looking as we start 2025?
We rounded out the year with a record-breaking month in terms of launches here at the NYSE. The industry saw 100 new ETFs launch in the month of December alone. In fact, it was the highest number of launches in a single month in our history here at the NYSE. So if we take a snapshot of 2024, that brings our total number of listed ETFs to 3,927, with 742 listed this year alone.
You mentioned breaking records. What other records can you tell us about, and what other noteworthy milestones jump out at you?
Sure, the industry has certainly experienced unprecedented growth and transformation over the past few decades, but 2024 marks a year of monumental developments, innovations, regulatory changes, and new milestones. It's hard to believe that it was actually this year only that we saw the approval and listing of the first spot Bitcoin ETFs, which quickly became some of the most successful launches in ETF history in terms of asset gathering and trading. It was also this year where we saw the US ETF industry surpass the $10 trillion mark in asset under management, as well as over $1.1 trillion in inflows into ETFs, shattering all previous records.
Yeah, it really has been an incredible year. So as we look ahead to 2025, what trends are you guys monitoring? Are we going to expect to see more crypto ETFs?
So as we look ahead to this year, there's so much to be excited for. We expect to continue to see the growth in the active ETF space, with over 2/3 of the new ETFs being active. There is a lot of opportunities for all types of issuers to bring new and innovative approaches to the ETF wrapper, giving investors access to strategies that were previously not easily accessible. We continue to see a focus on option-based derivatives and fixed income ETFs, with almost 4,000 ETFs available in the US. As a global leader in the ETF listings, the NYSE continues to focus on education and access to information. So, as I always say, I want to remind you to go to etfcentral.com and catch up on the latest ETF news and trends and all that is happening here at the NYSE, the home of ETF.
All right, we will let you get back to work. Maital, thank you so much. As always, it is a pleasure to see you, and we'll see you soon.
You as well.
And just a quick reminder to watch First Look ETF on Amazon Fire TV and Roku. Also, we simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so don't miss it. For some investors, finding undervalued investment opportunities in chaotic markets might seem like a daunting task, but a pair of equity ETFs from GMO with a hands-on approach and a disciplined framework promises to do the heavy lifting. Well, here to tell us more about it is Catherine LeGraw, Asset Allocation Strategist with GMO. Hi, Catherine. It is great to have you.
Thank you so much.
So before we talk about a few of GMO's recent ETF additions, what are some of the challenges that you see currently facing equity investors?
The number one challenge facing equity investors today is what to do about investing in the US. After some spectacular performance, the market is really expensive, with the S&P 500 near peak valuations. Add to that the fact that S&P 500 is also at peak concentration, with the top 10 stocks in the index making up the highest percent of market cap and volatility that we've ever seen. As a result, passive investors aren't getting a diversified basket. They're bearing a lot of specific company risk. These top stocks in the US have delivered extraordinary fundamental performance, but growth of this magnitude rarely persists for many years, and the companies have already benefited from multiple expansion. Finally, within the US, the dollar is also rich relative to most currencies. So today, that classic tension between greed and fear is acute. Investors are worried about holding on to an equity market that has experienced enormous multiple expansion, but at the same time, they're hesitant to step away for fear of missing out on a further rally.
A lot of good points there. Now, the GMO US Value ETF, and that ticker is GMOV, and then the GMO International Value ETF, GMOI. Those are recent additions to your firm's ETF lineup. Tell us more about the value investing strategy behind each fund, and then also with that, what types of stocks might we expect to see them holding?
Yes, GMO has now 4 active ETFs, GMOV and GMOI for value, in addition to QLTY, US Quality, and QLTI, International Quality. Value and quality are core areas of excellence at GMO and permeate absolutely everything we do. So we're so happy to have this capability available via ETF. These ETFs also might provide a solution to that challenge equity investors face of an extended US market, because they're all viable, attractive equity alternatives to an expensive, concentrated S&P 500 index. We're particularly thrilled about the value ETFs because value is extraordinarily cheap today, trading at one of the widest discounts ever relative to growth stocks. Value cheapness is 4th percentile compared to history, and it's only ever been cheaper at the height of the tech bubble or for a brief moment amid 2020 pandemic euphoria. So it's a wonderful time for value investing. In terms of our approach, it's differentiated in 3 ways. First, we look for top-down opportunities, and today that leads us to deep value, the cheapest 20% cohort. Deep value stocks are completely dislocated, and based on history, when value wins, deep value always wins by more. So we think this is the best way to target today's extraordinary value opportunity. Second, when selecting securities, we look beyond reported accounting data. GMO has restated the financials for all of the companies in our investment universe to better reflect underlying fundamentals. So as an example, we consider research and development to be an investment rather than just an expense. And third, we also create financial projections for every company, tailored to that company's unique characteristics, like their quality or growth prospects. In terms of the types of stocks you should expect to see in these value ETFs, stocks at attractive valuations that are still strong, profitable companies. Based on the comparisons I've looked at, GMOV and GMOI traded a discount to most other value approaches because we're going deeper into value. At the same time, the quality characteristics are robust, with metrics like financial leverage and profitability looking better than most value indexes.
So then how do you see GMOV and GMOI being deployed inside an overall investment portfolio?
Well, these ETFs can simply be used as substitutes for existing passive or active value exposure. Because we're going in deeper into value, when value wins, we expect to outperform traditional value. Second, if you don't have any value exposure today, you could use GMOV and GMOI to make an opportunistic bet on value. Value is extraordinarily cheap, and it's priced to outperform growth by 60% in a reversion scenario. So if you were ever going to consider value exposure for your portfolio, now is the time. Finally, you can simply use these ETFs as a way to diversify away from the expensive, concentrated S&P 500 index exposure.
All right. Well, Catherine, thank you so much for joining us. We really appreciate your time today.
Thanks for including me.
Private credit is an area of the bond market that is sometimes overlooked, and as a result, fixed income investors might not be getting all of the diversification benefits that they seek. Well, here to discuss a recently launched ETF that targets the private credit CLO marketplace is James Jessup, income strategist with Virtus ETF Solutions. Hi, James. It's great to have you with us here on First Look ETF.
Good to speak to you, and thanks for having me.
All right. So before we talk about the Virtus Sykes AAA private credit CLO ETF, and that ticker is PCLO, familiarize our audience with CLOs in the private debt market. What are CLOs and what are the potential investment benefits that they offer?
Sure. So let's start with CLOs. Collateralized loan obligations, or CLOs, are securitized debt instruments backed by pooled below investment grade corporate debt. So that's a mouthful, so let's unpack that a little bit. First off, in terms of securitization is a process most investors are probably familiar with. Securitization is the process of taking a number of different loans or debt instruments and kind of putting them into one place. This is the same process we're familiar with on the mortgage side, You also will see this on subprime auto and a number of other different debt instruments. And once that kind of securitization takes place, then they're broken out into what's called tranches, starting with AAA and then on downwards, AAA, AA, on down, all the way into single B. And what's the advantage to that is you get a lot of diversification quickly, but also the investor or the allocator can be much more targeted in terms of the amount of risk that they want to take on or how brave that they want to be, the type of income that they're looking to generate, and have a better understanding of kind of what they're allocated to in these diversified portfolios. From a benefit standpoint, CLOs, and particularly on the private side, it's a point of access to a vastly growing marketplace where we have seen investor demand, and it allows you to do it in a manner that is going to be broad diversified. Within each private credit CLO, you'll typically see between 80 and 100 different debt instruments or loans within those. So in a single ticket, you can end up with a lot of broad diversification. And you can also be targeted in terms of where you want to go from a risk standpoint and what your demands are from an income standpoint.
Okay, so now that you've defined that, the Virtus Sykes AAA Private Credit CLO ETF, and again, that ticker is PCLO. This is the first ETF of its kind, essentially. Give us a little bit more information about the fund's unique strategy and then dive into some of those holdings.
You touched on it at the top in terms of this is the first of its kind. And so when we were thinking about building this product out, this ETF out, what we thought about was this is going to be for a lot of investors their first exposure into the private credit marketplace. So as a result of that, we really focused on the AAA space, which is the most conservative within the group, also the least income available. The further down you go in any credit structure, the more income that you'll generate. But being in that AAA space, we thought it offered an opportunity to do it in the most conservative manner possible, give an investor something that's going to be short in terms of duration, and also hopefully generate some income somewhere between investment grade and also high yield. From a holding standpoint, as we sit here now, we're already in 20 different CLO deals, and within each of those deals is going to be another 80 to 100 names. Now, in terms of looking further into it, and this is an important feature on the private credit space, certainly part of PCLO, but the private credit market in general, they become opaque quickly. You can't get a great look through in terms of what are these kind of individual positions. That's the private nature of a private credit marketplace. And that's why we thought it was important to be in AAA and important to be in a number of different holdings from different issuers and kind of be as broad as possible, because part of the reason that you're seeing income where it is the opaque nature of it. You're kind of paying that premium, you're capturing that premium for not being able to see through on the individual deals. That's where some of that income will come from.
How do you see investors and advisors potentially using PCLO inside an overall investment portfolio?
I'm going to go backwards on that question. I'm going to start with what it's not. This is not a money market alternative. This is not a cash equivalent. This is not your new sweep account. This is a credit product. And the reason I share that is with the income where it is and with a AAA rating, we want investors to have a good understanding of what it is that they're taking on from a credit risk standpoint, what they can expect from a volatility standpoint, and kind of what it's going to be. Now, the age-old question of kind of where do I put it or why would I use it? You don't have exposure to this place already. That's one of the reasons, broadly speaking, most allocators don't have a dedicated portion in private credit already, particularly in the retail space, which is an important part of our client base. And so this is going to be that first step into there. And that also, to go back to portfolio construction, that's why we focused on the AAA space, is we wanted to kind of give the most conservative allocation possible initially for someone who's coming into this space for the first time and getting the benefit of that income, again, that income sitting somewhere between investment grade and high yield, but giving that new broad diversification in a single ticket and giving an opportunity to participate in a marketplace that is growing quickly and also growing not just from an asset management standpoint, but also from a mindshare standpoint. This is one of the leading topics in fixed income at this time, and we're happy to kind of be participating in it and offering very early in the life cycle.
All right, James Jessup, thank you so much for sharing more about PCLO today. We appreciate your time.
Thanks, and have a great day.
And that does it for today's episode of First Look ETF. If you liked the show, please tell us in the comments section below and by hitting the like button. Want to give a big thanks once again to all of our guests, along with Maital Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks so much for watching. We'll see you next time.